Matt, so good to see you. I'm glad you have time to talk today because I really wanted to talk through the markets and geopolitics. Rising tensions in Iran have pushed oil prices higher and created short term volatility in the markets. Historically, however, geopolitical conflicts tend to have only a temporary impact on stocks. As we record this on the last day of April, let's take a look at the S&P's 1 week performance. We see some red, we see some green on the board. Why do we tend to see stocks fall first when tensions rise?
Two things. One is fear. People tend to have the knee-jerk reaction of the world's going to go to pot. We're in trouble. Let's get out now and move to something else. But the other is uncertainty. The stock market does not like not knowing what's going to happen. So the certainty could be numerous things. It's always something different. But those are the two main reasons why retail investors get out of the stock market, making the drop worse than it needs to be.
Yes, exactly. Whereas, on the other hand, you, as a student of history, you brought this chart to my attention, which I think is great. So this shows the S&P usually recovers quickly from geopolitical events. As we can see here, several events and mostly short, shallow pullbacks. Can you explain what we're looking at, please?
Yes, if you look at the bottom right corner, that is, you see the 5%. So that is how far the market pulled back. And then on the right, you see the days. So most of the drop in the market was less than 5% and less than 50 days. And one thing we always like to remind people is the best days in the market are right beside the worst days in the market, which means the worst days in the market are right beside the best days in the market. Look at this last March 31st, Aaron. It was doom and gloom. And, the headlines were concerning. There was a lot going on that day. And people were very concerned. And some clients called me saying, Matt, we got to go to cash.
Yep.
Yeah. And I said, hey, I understand. It's scary and there's a lot going on. But I said, the reality is this. If something does happen that day, what's going to happen to us? Am I still going to go to work the next day? I am. Is Microsoft still going to open? Yes. Am I still going to buy gas and groceries? Well, we are. So no one likes political uncertainty, and especially when it has to do with war. But my point is this: we've been through war cycles before, and always come out ahead. And let's not, it's interesting that the market pulled back up on April 1st, April Fool's.
Exactly. So, yeah, you don't want to miss that rebound.
You don't want to miss
the rebound. To that conversation then that you were having with clients, I'm sure your second or third question to them was, have any of your financial goals changed?
Yeah. Do you need the money today? No. Are we pulling it out tomorrow? No. Are you buying a new house tomorrow and taking everything out? Well, no. So a down market is really only bad for the person that is taking out too much money on that day.
Right.
If you're accumulating, you want a down market because you're buying on sale. Or if you have guaranteed income that meets your needs, it's a moot point. But we factor in market corrections in our portfolios is something we're prepared for.
Right. And so just to kind of repeat the question in a different way, for investors watching these headlines and rising oil prices, what's the most important perspective to be keeping in mind before making portfolio decisions?
Have your retirement goals changed? Has your retirement date changed? It probably hasn't. So what we don't want to do is chasing last year's winners for this year's losers. We want to keep our portfolio diversified.
Right. Now, on that note, when we hear these scary headlines and people who don't have you as a resource pull their money out of their portfolio, this is what's known as emotional investing. Can you explain how this tends to lead to bad financial decisions?
Yes, because it's just a matter of when you got into this chart. For example, the euphoria, we all think we're going to be, billionaires, we're making all this money. But then what happens over time is things change, just like this March 31st, the market was down and people were very concerned. If we went to cash and we got to despondency, what would have happened if those people that called me went to cash on March 31st? They would have locked in their losses. This is what the market does, Aaron. It goes up, but you know what? I can guarantee you before now and the end of the year, well, I shouldn't say guarantee, but the market's going to go down again. It is going to go down. And then after that, it's going to go up. So people that are constantly predicting the doom and gloom, the advantage that they have is they're right, because there is going to be a day of doom and gloom.
Right.
But we have to remember the sun's coming up in the morning. We're going to have a good day.
Right, right. I think the one time our compliance team will let you say the word guaranteed is when you say that it's a guarantee the market's going to go down. Of course,
There we go.
volatility
We
is
can
the
say
one
that.
thing we can count on, right? Which is
That
why
is,
having that plan is so important. So, Matt, if somebody would like to sit down with you, design that financial plan, or find one that's in line with their risk tolerance, if they aren't feeling comfortable, what's the best way to reach you?
give us a call at 425-256-3105 or throw me an email at mberkland@shoesvault.com.
Great. Matt, again, thank you so much for your time today. I appreciate it.
Thank you, Aaron.